I mentioned last week, but for those listening for the first time, I have my first sponsor, and I could not think of a better one than mempool.space, a fantastic Bitcoin block explorer. We are still using Wiz's mempool here, but like most things in my life, I'm moving towards free and open source software, and you get that with this Bitcoin block explorer. So you do not need to trust Wiz's mempool, i.e. mempool.space. You can easily host it yourself. More to come on this front at the park in 2023. But mempool is becoming much more than your traditional block explorer. It is becoming a multi-layer explorer from layer 0 mempool, layer 1 the Bitcoin blockchain, layer 2 plus like Lightning, Liquid, and more. And that more part is for those interested in Bitcoin mining. They have a robust mining dashboard, which I check every day. And as I click on the hammer in the upper nav bar and then scroll over to the right, I see the expected difficulty to adjust downward by about 7%. Hallelujah. So give it a shot yourself at mempool.space.
So for all of the mainstream journalists, they seem to approach Bitcoin and cryptocurrency with this kind of nihilistic lens of this thing is only bad. And the only serious way to cover it is to show that it's bad. And these publications don't want to get someone who is an actual Bitcoin freak or a crypto head onto their masthead because then they see it as a conflict of interest. So like it's this weird catch-22 where it's like you're never going to get someone who actually understands how to cover this stuff unless you get someone who's interested in it, because they're the only people who actually understand how it works.
Welcome to the Builders in Bitcoin podcast, a podcast about the people who bring Bitcoin to life. I'm your host, Rod, and I go by the handle BitKite on Twitter. This week, I sat down with Colin Harper, writer and researcher at Luxor Mining. Colin is leveraging his writing prowess to shed light and inform on the Bitcoin mining industry. In this episode, we discuss and dig into the current Bitcoin mining environment, leverage in the mining space, how prospective miners can find an edge over the competition, and a whole lot more. I really hope you enjoy this episode as much as I did, so let's just jump right in. Colin Harper, welcome to the Builders in Bitcoin podcast. How the heck are you?
I'm doing well, Rod. Thanks for having me, man. Super excited.
Yeah, man.
It's a beautiful day here in Nashville, Tennessee. It's always a beautiful day in Nashville.
I just got back from a tropical vacation, first vacation in a long time. I won't go into the details of why, but it was good to what's it called? Like
Unwind
or what is it? Unplug for a few days, even though I really didn't. But it was good to just unplug. Coming back to Nashville last night, I mean, it was cold AF. But actually, today's been beautiful.
Yeah.
A nice little fallish, winterish day. It is always good to hang with another Nashvilleian, and you're going to be here for some time working from the park, which will be nice.
Yes, sir. Yes, sir. Here until February, and really looking forward to just hanging out here more. Today has been awesome, just like meeting all the people coming through, and the park really is just like, I know this is probably gets said a few times on this podcast, but for anyone listening, you should definitely come make the pilgrimage to check it out. It's a really cool co-working space.
Thanks, man. And January 11th, you're going to be at the meetup, the open house meetup, Mining to the Moon, and you're going to be one of the panelists. So I'm going to be updating that page and excited to have you back. This will be your second meetup here in Nashville that you'll be participating in.
I think second or
maybe third, actually.
Third, yeah. First one where I'm speaking at it. Looking forward to talking about mining to the moon, and also maybe throwing in a little dash of realism, where it's really I don't know, mining at the pits of the bear market.
Sorry, let's just jump right into it. We'll say miner to miner. I mean, let's go right. So quick background on Colin. He works at Luxor. How would you explain Luxor to people?
Yeah, Bitcoin mining software and services. So like one of our core products is the pool, the Bitcoin mining pool. And we've also got an ASIC brokerage arm where we match buyers and sellers for Bitcoin mining equipment. Also have a hosting marketplace that matches hosts with potential clients and vice versa. And most recently, the product we're probably most excited about this year is our hash price derivative, which is like a non-deliverable forward contract, and we can get into that later. But it's basically a way for miners to sell hash rate forward and to hedge their exposure to Bitcoin's difficulty and the volatility. So hash price, for those who don't know, is a way to measure Bitcoin mining revenue per unit of compute power. So we usually measure it in like dollars per petahashes. And so with something like the hash price NDF, it allows miners to basically offset their exposure to Bitcoin mining difficulty changes, because when difficulty goes up or down, hash price will change accordingly. And it also goes up or down with Bitcoin's price in dollar terms. So
Okay. It seems like a lot. It seems like basically a full service mining shop for anyone interested. Uh, what have you been seeing, hearing, experiencing as it relates to mining now? Because, back let's say 12 months ago, everybody and their mom was plugging in miners. Was it just 12 months ago? Yeah, probably. Um, and now it's exahash has gone way up. So it's, everybody and their mom is mining now. And the Bitcoin price has just taken a nosedive. So that's what I call the baddie quadrant. Um, and I'm feeling the pain too, that's for sure. What have you been seeing? What have you been experiencing?
yeah, so I think you kind of said it right with last year, especially in the United States after China threw the ban hammer on Bitcoin mining. A lot of that business migrated to the US. Some of it went into some, Central Asian states and also Commonwealth states like Kazakhstan. But a lot of it came to the US and Canada. And when you had this migration, you essentially had obviously not only an influx in business from China, but you had an influx of enthusiasm from US based investors in Bitcoin mining, because for the first time, you know, since probably like the very early days of Bitcoin, all of the different, um, verticals for mining became much more accessible. Like machines were much easier to come by because, all the Chinese miners were either moving them here or selling them. Bitmain and MicroBT had to open up, obviously, more avenues in the United States to make money. Whereas before, the investors and the miners who got first dibs on anything were in China.
Mm-hmm.
And so when you had all of that business move over here, it kind of created this perfect storm, because you already had people hopped up on the euphoria of the bull market, right? And then now there was this business line that is like, in some ways more intuitive to some people than buying Bitcoin outright, especially old finance types, because it's like a cash flow producing business. Whereas like, guys like my dad, they didn't understand just buying Bitcoin outright. But like the idea of like owning a miner that produces the commodity, that was very attractive to them.
Mm-hmm.
So once you had that come over, I think that like it just added fuel onto this fire. Like bull markets always create irrational exuberance, and that's what you saw last year and for the first part of this year. And I don't know, kind of like you said, now Bitcoin's hash rate is at like I think 261 exahashes the last time I checked before getting on the podcast.
Like the 30-day moving average, or
7 day.
7
Yeah,
day?
30 days is probably a little bit lower. Or it might be actually close to that, because we've been riding at like 270 for the last week or so before it came down. But Bitcoin's price is at like 15.8 right now or something like that. And hash price, what I was saying earlier, we're at I think like $56 per petahash. And for people who like that might not mean anything, like the average last year was like $300 per petahash. So you're basically like
God bless.
yeah, I know. It's like, a sixth of what it was for the average last year. So a lot of people got in last year when the getting was really good. And one of the biggest mistakes you'll see with especially first timers with Bitcoin mining is they'll model out future revenue projections based on the current hash price and profitability environment, right?
Mm-hmm.
And so you had a bunch of people last year in pitch decks and like raising money, looking at how much money they could be making at that point in time. And now they're just now getting those machines online that they raised for last year, and those machines are barely breaking even. I mean, to put it into perspective, if you have like a new machine like an S19J Pro, your break even right now if your electricity cost is 8 cents a kilowatt hour, which is like kind of the new average for like hosts for like retail and stuff like that. So, I mean, not to name any names, but like if you're using one of those retail hosting arms and you have 8 cents a kilowatt hour or even 7, you're break even or you're sweating.
Yeah. We're going to unpack and dig into that because I'm very interested in that. So maybe just for the listeners, what's your role at Luxor, and maybe a little bit of background?
Yeah, so I do basically writing and research for Luxor. So I'm the head of content and research. So I produce our weekly newsletter. curate, coverage and research from some of our contributors. We got a few guys writing for us. They mainly do mining stock coverage. This pseudonymous dude named Balmy Investor, and also one of Arcane's crypto's former analysts, Yaron Mellerud. They do a lot of Bitcoin mining stock coverage. So you can check that out on hashrateindex.com/blog. And then I also do like a little bit of everything, like public relations stuff, media relations, a little bit of marketing. And probably the thing that I like most interested in or most proud of is our like quarterly and year-end reports. I basically craft those from the bottom up, work with one of our designers to get them out. So a lot of words, a lot of research, things
How's
of
that
that
coming, by
nature.
the way?
The year-end report?
Yeah.
Yeah, it's in the embryonic phase right now. We haven't really started much with that. I mean, I've got some ideas, always trying to iterate on what we did in like past reports, but that is kind of the problem. It's like once I finish like one of the quarterly ones, it's like I have like a month and then to rest on my laurels, and then I have to like work on the next one. So that one will probably be coming out like first, second week of January, the year-end one.
I forget what someone had this quote, and sorry, I'm not giving the proper, what do you call it, credit to, but it's like, how do you go broke? It's like liquor, ladies, and leverage. And I feel like the next one is like Bitcoin mining.
Bitcoin.
But I will say, for the folks that don't grok Bitcoin, like you said, I think your father or your grandfather, it's like, oh, I get picks and shovels on like being in the ecosystem, but I just don't want to buy the asset and hold on to it.
Yeah.
They want to actually invest in the thing that is creating it. The problem there is there's so many variables associated with Bitcoin mining. One of which is, I didn't realize this until a bit ago, is how much leverage there has been in the mining space. Maybe you can just shed some light on the amount of leverage.
Yeah, I mean, so a lot of the like specifically public companies, one of their primary methods for fundraising in the last few years has been through like taking out debt, loans from various banks and different companies. They're starting to move towards equity financing more recently, or equity fundraising more recently, because they just have run out of avenues to get cheap debt. Rates are rising, and also Bitcoin is not at 60K anymore. So those capital spigots are kind of turning off a little bit. But yeah, I mean, if you look at some of the debt to equity ratios of some of the miners, they're incredibly high. I mean, I don't have figures in front of me right now, but like some of the highest, for instance, are like Core Scientific, which they're pretty, embroiled in a lot of debt right now, and like.
Maybe you could explain like what kind of debt. You mentioned debt finance, but are they like leveraging their machines? Are they leveraging their?
It's always a mix. It's a mix of everything. So, some of these debts are like collateralized with machines. Some of them are with Bitcoin. For like machine financing specifically, it's not uncommon for these miners to take out a loan to buy more machines and then use those machines as collateral. This is something we were talking about earlier.
Number go up.
Yeah, which is crazy, right? Because right now, ASICs, like a nice new gen ASIC like an S19J Pro, like will run you about $2,000, for a 100 terahash machine. And at the peak last year,
a terahash.
Yeah, basically. And then, last year, during the peak of the market mania, they were selling for 10 to 12 grand, right? So it's like, and more sophisticated lenders know this, and they have it baked into the way that the loans work, right? And so like the loan to value for the collateral is, oftentimes accounts for these things. One of the other kind of loans that we also see a lot are obviously Bitcoin backed loans. A lot of these miners mine or hold a lot of the Bitcoin that they mine, and then they'll put that into some sort of lockup to get cash from a lender. Like Galaxy was one, Genesis was another. I think, Hut 8 used to use Genesis, but they don't anymore. They got out of that loan pretty recently. And then for some other ones, I don't know what the collateral for loans like this are, but like Marathon, for instance, I need to be fact checked on this, but like they had at least $100 million last year from, I think it was Silvergate, and it was like extremely low interest, but I don't know what collateralizes that, right? So sometimes these loans are just straight up cash injections for whatever. Sometimes that'll be just for like paying, down operational expenses, paying for expansion, things like that. Other times, they use them for, like just direct ASIC financing. And there are like a couple of shops that have specialized in that, like BlockFi has done it. NYDIG does it. Galaxy has done it. I think Genesis has done it. And those loans often carry a pretty high interest rate, like anywhere from like 10 to 20%, depending on who you're going to. Oh, Foundry's another one.
Mm-hmm.
That's one of the ways that Foundry grew its pool so quickly is they did ASIC financing and said, if you finance through us, you have to use our pool. And Foundry has some of the highest interest rates in the space too. And that's another thing too, because last thing.
Yeah.
As mining margins evaporate, some miners can't pay back these loans.
So what happens?
Well, a good example of what can happen sometimes with this is Stronghold Digital, publicly traded company. They returned it's like 26,000 miners to NYDIG when they just couldn't pay back the loan. So if you can't pay back the loan and you default on it, depending on depending on the way that the loan's structured, usually that just means that the miners get returned to the company that financed the loan.
So does NYDIG just turn around and go to a brokerage service like you guys to say, hey, sell these on the market?
Yeah, could be.
And then
I disclosure, I don't know.
Yeah.
But that would be the
like
obvious,
a brokerage service.
Yeah.
Maybe they have someone internally that's just handling it.
That would be the obvious thing, right? But they probably do it OTC or something like that. And then that kind of carries like usually like those will be discounted a little bit, especially for like a massive order like that,
So do you think people or these companies then, okay, so the total exahash, I have my own opinions, but I'm curious about yours. Because this is the podcast I got to run. But all right, so I think a lot of people are going underwater right now or going to be definitely underwater here soon. We're at 15.5. Total exahash roughly is just under 300. Do they unplug, run unprofitably? What do they do?
It depends on the miner, right? So if you're like an industrial size miner, first of all, most of those dudes, I guess this is worth saying. Not every miner is not built the same, right? Like there are publicly traded companies that are more well run than others. The ones that are more well run didn't get ahead of their skis last year. They like expanded prudently. They didn't blow their load. They didn't buy too many machines that they can't plug in, and they didn't take on too much leverage, right? There's always a trade-off, right? Like, do you raise debt in at a time when credit's cheap, and then maybe have to pay the piper later when you're not making as much money, or do you like dilute your equity and piss off shareholders? So like,
or do you have good disciplined unit economics around margin, and then you're selling the Bitcoin at the time and then just pocketing the net Bitcoin rather than holding the Bitcoin, taking a loan against it, levering up, getting a variable interest rate against that, buying new depreciating machines.
Right. And a great example of that, of like just selling Bitcoin as you go, CleanSpark. They have been kind of expanding pretty aggressively in the bear market. Are
they public?
Yeah, they are. But they bought they had two acquisitions recently. One was one of Mawson's sites in Georgia, and another one was a Bitcoin mining site by I think this like smaller public or private company called Waha. But they didn't hold their Bitcoin, and a lot of these miners like held at the top and then have sold at the bottom.
Mm-hmm.
Obviously, you don't want that. But to go back to your original question, like what happens when these miners go underwater? Well, some of them at the industrial scale, it might actually be better for them to continue mining at a loss versus turn off their machines, because in the power purchasing agreements that they have to post collateral for like, if you say that you're going to purchase, 10 megawatts of power for so-and-so amount of months or like for a year or two, like you have basically a cash deposit that you have to make as collateral for that.
Mm-hmm.
And if you stop drawing that power or you can't pay your bills, then they just take your collateral. So for some of those guys, it might make more sense to just kind of ride it out and like take the losses and like see if you can somehow fundraise another way.
Mm-hmm.
Like if you're a public company, maybe you do another equity round, or maybe you try to find some debt or like sell off some old assets. For smaller scale miners, if they're not making as, I think maybe this is wrong, but like what makes sense to me is like the smaller you go, the more likely you're like probably gonna just like cut your losses and leave because there's not as much on the table in terms of like you haven't staked as much. But like if you have hundreds of millions of dollars or tens of millions of dollars invested in one of these mining farms, then you're probably going to stomach the loss for longer to wait
Hmm.
to see if your luck changes or to see if you can somehow, raise capital to kind of dig yourself out of that hole. But it's kind of like, it's a vicious cycle, right? Because like you're down and then you keep trying to raise and then now you owe more money or you don't have as much or you don't have as many shares or your shares are
Yeah.
diluted. So,
Just having some gunpowder is mission critical
mhm.
that I've learned. And two things I've learned. One is your entry point to buying a machine. So to your point around the $10,000 to $12,000 for the S19J Pros, I always look at it, and you do too, which is the price per terahash. So like $100 plus per terahash. These publicly traded companies were buying future orders at $100 plus for the new gen S9 or the S19 XPs at like $100 plus. And now they're trading for, I don't know, $40 a terahash for those, or maybe much
Yeah,
cheaper.
and worth pointing out too, some of these like the publicly traded companies and the people with not even the publicly traded companies, but like private companies with size,
Hmm.
like they have different terms than most people do. Like if you're buying direct from the factory, like for instance, Bitmain, uh, for the S19 XP orders, the original batches, they actually like issued credits against those because the price changed so dramatically.
Oh, really?
Yeah,
Okay.
yeah. I mean, but
I
to
thought it was like 50% upfront, no backsies, and then 25% like 90 days later, then 25%
Yeah,
on
yeah, so they
deliveries.
are structured like that where, like, you'll put money up front, and then you pay more as you pay the rest as you get closer to delivery date. But if you looked at, the first, like, I think it was the August and July orders of the S19 XPs, they issued credits that I don't know how much they were worth, but basically the miners got a little bit of a or Bitmain took a little bit of a haircut on the original price. But that being said, you're still buying at elevated prices. Like you're buying, the machines at a time when they're more profitable and they get delivered when they are less
Hmm.
profitable. But usually because of that futures orders, especially several months out, they'll usually carry a discount. And if you actually look at like S19 XPs, I wrote about this in our Q3 report, the first month or so that they were on order, they were actually heavily discounted compared to if you were buying similar hardware, like an S19J Pro in terms of
Hmm.
dollars per terahash. Like the XPs had much lower dollar per terahash, or like a few percentage points lower dollar per terahash cost than the S19J Pros. But that's completely inverted now because now they're on the market and everyone wants them because they're the most efficient.
Yep.
And if you have them, then you're going to be better positioned to actually weather the bear market.
Exactly. That's going to be my second point, which is like paying the premium, buying new gen stuff. You can weather the storm obviously much longer than somebody, obviously with an S9 or even an S19 Pro or whatever the ones that are the least efficient, because it's going to matter,
Yep.
especially with this insane pressure on price, which is pushing down the hash price even more. Not to be in the prediction game, but I am curious based on all the information that you're gathering and what you're seeing. Total exahash is obviously one of the biggest driver here.
Hmm.
Um, Everyone was making their own predictions for the year end, and we're only 45 days or less than that, until the end of the year. With these publicly traded miners, and I think Ethan actually tweeted out something around the top traded public miners make up like 25% of the total exahash. I should pull that up to fact check myself. But yeah, so anyways, where do you see total exahash kind of tapering off, going down if more miners are unplugging, or heck, you know what? This is People are finding cheaper, more reliable energy sources and are just plugging in very cheap ASICs.
Yeah, so I think that for the remaining month and 2 weeks of the year, I think you'll just kind of see what we've seen so far. Hash rate's not going to be parabolic because it just can't right now. Like it's not going to increase nearly as much as people thought it was at the peak of last year's market mania. But you're going to continue to see it increase. I think that somewhere in the ballpark of 270, 280 by the end of the year makes sense to me.
30-day moving average or
7 day.
7-day?
Yeah, for the 30-day, probably like 270, or like 265 or something like that. But yeah, it really depends on how much those public companies can execute. Because a lot of them are in trouble right now. And, if one of the big ones like Core Scientific goes bust, if they turn off their machines, then that's like, or if they're like, they probably wouldn't turn them off. If they went bankrupt, they wouldn't probably turn all of them off. But if for whatever reason, like Core Scientific decided like it was just done and it like powered down, and that would be 10 exahashes of their own hash rate taken offline. And
But
depending
they
on,
wouldn't. How is that possible for them to just do
I don't
that?
think it would happen.
Yeah.
Yeah, I mean, they're going to probably, even if they go bankrupt, they're going to keep mining through the restructuring. So, but yeah, all of that said, and that's another thing worth pointing out. Like, for some of these bigger companies, if they do go bankrupt, like those assets aren't destroyed; they just
Mhm.
change hands.
Yeah.
And someone's going to have a really sweet deal on a lot of ASICs that are already energized, right? So, I think that for the next month and some change, you'll see some smaller miners turn off just because they can't stomach it, and that will kind of keep hash rate from growing exponentially. But if you look at the chart right now, it's kind of this like stair step
Mhm.
progression where it's like hash rate has this huge surge and hash price drops as a result. And then hash rate, after the hash price drops, the hash rate kind of tapers down just a little bit or
Mhm.
like plateaus because you have miners turning off that offsets the rise. So that's the other thing. I mean, it's kind of elementary, but it's worth pointing out. As hash rate rises and difficulty rises and hash price goes down and miners are making less money, miners who are higher up the cost ladder and who have less efficient hardware are either washed out or they just turn off and just wait until there are favorable conditions. So there's kind of this like push and pull and ebb and flow and this kind of like equilibrium in the way that hash rate progresses, right? So like once you have those big moves upward, especially in a bear market,
Yep.
you have a period of kind of like stabilizing where like hash rate plateaus and we don't have huge difficulty swings until someone gets a bunch of new machines and cheap energy and deploys them, and then it goes up again.
Are you hearing anything new about new machines?
Not really. Yeah, so far it seems like the S19 XP is going to be kind of the like king of like the new efficient, the most recent and efficient hardware. Intel's ASIC chips, which like I guess a distinction here, it's like Bitmain and WhatsMiner. Like when you order their machine, like you're ordering a computer,
Yep.
right?
Fully assembled
Fully
computer.
assembled. And for Intel, it's looking like a lot of their machines, like either the miners who are buying them or assembling the machines themselves.
Mhm.
Like I think that might be what Block is doing, formerly Square, or they're like being bought to do immersion mining, which I think is Argo's play. Like Argo bought a bunch of Intel block scale ASICs, and I think they're going to put them in their immersion setups. I don't know for sure, but I'm assuming based on what I've been told and what I've researched. But yeah, so far, like Intel is the newest to the game. Blockstream bought Spondoolies last year, but like I have no idea what's going on with that. I haven't heard anything new about what they're planning to do. Spondoolies was like one of the first ASIC manufacturers. They did, I think, Bitcoin mining ASICs, but they like got famous doing Dash Bitcoin miners.
Yeah.
For anyone who knows what Dash is,
I
it's like
do
a
not. No.
dinosaur of an altcoin.
So, yeah, that's a nice tangent there. These different machines, I mean, it seems like everybody and their mom over the last 12 months, including me, got into Bitcoin mining. Would you recommend, by the way, folks to get into Bitcoin mining now?
Here's what I would say. I'd say it's probably better to get in now than it was last year because, like, at the very
Yes.
least, ASIC prices are depressed. They're still a little too high if you want like a good ROI, unless you have cheap energy.
What do you define as cheap energy?
Like less than 4 cents.
Wow. Where are you getting that?
If you find a guy, you let me know, Rod. But yeah, that's what I would say. It's like, I mean, if you're just like a passing observer and you're like, oh, Bitcoin mining sounds cool, I want to get into it. I would just say, like, just if you're okay with losing money, then go for it. Like, seriously, or if you wanna, like, toy around with just, like, 1 ASIC, I mean,
Yeah.
like, 2 grand, if you have, like, decent energy, like, it's, you know, not the worst, it's not gonna, like, put you out of a home, right? Versus, like, some of these dudes who are, like, taking out second mortgages on their home last year and, like, plowing $200,000, $300,000 into setups with some of these retail-focused hosts, and I'm like, I don't know what those dudes are doing right now, right? I would be, especially if I had a family and I was just, like, using one of those companies, I'd be kinda sweating. Um, but I would just say if you're, like, thinking about getting into Bitcoin mining right now, you really have to have an edge.
Hmm.
Like, and that edge could be maybe, like, someone in your family, like, drills for gas, and they have, like, an off-grid, nat gas well, right? Where that energy is stranded, or they have no way of getting it to market, and then so you can convince them to, like, put a Jenny on there, a generator, and then, like, mine Bitcoin with that. That's an edge. If you're a utility provider or you know someone who is a utility
Hmm.
provider and you can get, privileged access to energy producing assets, then yeah. But I guess that's what I would say is, like, if you're gonna try to do this, you have to have some sort of edge to give you, especially right now, to give you a boost in profitability compared to your peers. Because if you can't find that cheap energy, then it's not gonna be worth it. That being said, now is the time to start thinking about how you would do it, because the key right now in the bear market is, like, if you're trying to mine, survive until the next bull market, and if you already have your ASICs and your machines in place,
Plugged in. Yep.
then you're just ready to go, and then when the next bull market comes, you're gonna feel like you're printing money.
Yep.
So,
Yeah, I would say agreed on like maybe one machine. I definitely consult an electrician, break it down, build it back up, literally learn like how the hash board works, how fans work, and really, if you want to get into this, which it is not for the faint of heart, that's for sure.
that was the biggest trap last year, is, like, everyone was like, "Oh, this is, like, a super passive thing. It'll be easy." Like, you just plug in the machine and then you make Bitcoin, right? Like, how hard, like, "Oh, and you just need to manage the power contract," right? And that's what people
Here's my
thought.
ROI calculator. Difficulty goes up 0%. Price goes
Yeah,
up 20%
exactly.
year over year, or 100% year over year.
Exactly.
My payback period is 8 months.
Yep,
Yeah, on a $100 terahash machine.
yep.
Futures order plugged in 6 months. But I digress again. Look, at least at the end of the day, consistent, reliable energy at a scale that you can afford and swallow the short-term minimal gains or pain to be able to outlast it. The only problem we have is we're coming up every day. We get closer to the halving, which is just scary just to even think about.
Yeah. Yeah, I mean, if you're in right now, you wanna obviously make as much as possible before that happens, because if Bitcoin's price is not ripping at that point, then you're gonna be a sad, sad miner.
So, like on the mining pool side, I am always curious. Competition, I always think is like a really good thing. And Foundry came out of nowhere. You guys, to a degree, came out of nowhere. Like, how do you guys differentiate yourselves from the other legacy mining pools?
Yeah, so I think that the number one thing, particularly for, like, a North American facing mining pool, there are 2 components for differentiation. I think the first one is, like, and this is gonna sound kind of, simple, or kind of like, "Well, duh, dude," but you'd be surprised. It's just, like, having really good customer service.
Hmm.
Like, a lot of the, like, legacy mining pools, like the China-based ones, they were just super not lucky. I mean, they built their businesses.
First mover.
Yeah, first mover advantage, and they kinda got lazy because, like, there are a few things that, like, you just build up, a client pool, and you're, like, the only game in town. Like, for instance, if you're one of, like, the several Bitmain, mining pools, like, I mean, they were all kind of fragmented, so it doesn't look like it's Bitmain, but I think it's, what was it? Like, BTC.com via BTC and F2 pool. I could be wrong about exactly, I could be wrong about the last one, but at least via BTC and BTC.com were basically, like,
Hmm.
both a part of the Bitmain empire. And so, like, when you have, that first mover advantage, and you have, the network effects therein, especially in the early days, when there's not as much competition, then it just doesn't matter. And a lot of these pools were built for like Chinese clientele, right? So like most of the important big miners mining on them knew the staff working there, had close relationships with them, and so they got preferential treatment. And but if you're just like a little miner with like a few petahash, like they don't care. So good customer service and just customer relations um, in this industry really goes a long way because miners have been used to pretty, you know, to put it in a kind of charitable way, pretty lackluster, customer service. The other thing too is going forward, we believe that um, the Bitcoin mining pool is going to be like a secondary kind of product offering. Um, and there are going to be services built around a mining pool that are going to win miner loyalties, right? So, like a good example of this with Foundry has been their ASIC loans, right? So they basically offer a loan to a Bitcoin miner, and then with that loan, they then draw them into the pool. For us at Luxor, we believe having ASIC brokerage services and also our hash price NDF could be kind of a sweetener that then attract people to the pool. So you're basically building services around the mining pool to keep the miners stuck with your company, or like to build loyalty with that company, because mining pools of themselves like don't really make that much money.
Yeah.
They're not super profitable long term.
We're going deep, Tom, into mining, which I know you love. But so for a layman like me, can you explain derivatives and like this new derivatives product?
A layman like you, I'm a layman, Rod. I studied Faulkner and Shakespeare in college. I don't know all this fancy finance stuff, but I'll do my best.
What'd you study in college?
English and literature. So yeah, I thought I was going to be a professor, and then I realized that was an abysmal way to try to make very little money. So then I went into Bitcoin mining, so I could also have an abysmal way of making very little money.
I can vouch for that.
Yeah. So a derivative contract in legacy finance is just like a financial instrument that is tied to some sort of underlying either commodity or asset, right? So, like classic example, when most people think of futures, or most people think of derivatives, think of like futures contracts, like going long or short something, right? For Luxor specifically, our hash price NDF, NDF stands for non-deliverable forward, and the non-deliverable there just means you're not being delivered the like actual asset, you're being delivered cash in lieu of. So like in the like commodities, derivatives field, you can like buy futures that are like in kind, which means they're like actually delivered in the asset that you're trading, or they're cash settled. And so for Luxor's NDF, just for a quick breakdown for your listeners, what you would basically do is if you're a miner and you want to sell hash rate, let's say you have like 10 petahashes, which is 100 S19J Pros at 100 terahash. If you have 10 petahashes, you can say I want to sell all of the hash rate or all of the productivity from these Bitcoin miners for, let's say, like right now, hash price is $56 per petahash. You want to sell it at $56 per petahash.
Is that like based on 100% uptime? Or
yeah, more or less. I mean, like there's probably some nuances here because I'm not on the derivatives team, but like for the sake of this, like we'll say it is.
Okay.
And so you basically say that you want to sell, $56 per petahash, for, let's say like a month for the contract duration. Then you have, so let's say I'm selling you that, and then you're the buyer, and you say, okay, that sounds good to me. Like $56 per petahash seems fair. So you decide to buy that for me. So you pay me upfront for that hash rate. And then over the course of the month, we take the average of the actual hash price of Bitcoin based on Luxor's hash price index on hash rate index. We track this on hashrateindex.com for anyone wondering. And so we take the average hash price for that month. And if it is below that $56 per petahash price tag that I sold my hash rate for, as a miner, I just made money because I hedged downside. If it is above that $56 per petahash let's say it's like $60 per petahash on average, then I pay out the difference at the end of the contract in cash.
Got it.
So for miners, it's a way to hedge downside. And for anyone else, like let's say you're like a hedge fund or a trading firm, it's a way for you to make short-term plays on Bitcoin and trade the asset without actually
holding.
Yeah, and trade, like exposure to mining without having direct exposure.
Yeah. That's interesting. I'm curious to know, maybe in a month or so we can come back to that. When did you guys launch that product?
Let me think.
Well, it's a more recent product.
Yeah,
so
I think
I'm excited to see if it
I think it was
takes
like
off.
October.
Okay.
Yeah.
So you head of content and research, been in Bitcoin mining now for a bit, but before that you were, and you still are, a journalist.
Yep.
Yeah. So you still write as well?
Yeah, I do. I write for Forbes once or twice every month, depending on
They
how busy
crush it with their covers, by the way, Forbes.
Was that a joke?
Well, no. I mean, you got
Because
you got Elizabeth Holmes on the cover. You got Sam
That's what I was about to say. Because Sam
you got
was
some really notable people that grace the cover of the publication that you write for. So congratulations.
Yeah, thanks, man. It feels great to be associated with a publication that had a cover story for Sam Bankman-Fried right before he blew up.
So
that was literally in like September or October. Like,
of this year?
Yes. My editor was talking to me about it. Like when I was over July, he's like, I'm writing this cover story about Sam.
Oh, really?
Yeah.
Oh my God. So, in a messed up situation, whoever his PR firm is, they're just like,
he, like you couldn't write the book on how to curry favorable coverage better than FTX and Sam did. I mean, and maybe this is just like, we'll just like hop right into it. I don't know if this is the next thing you want to talk about it, but he and FTX were trained to do this. Like they, between like the way that they played donations, the way that they got coverage in all of the right magazines
at the right
and
time.
online publications at the right time. I don't know if you look at who his parents are and if you look at, who they're connected to and all this other stuff, to me, it was just like teed up perfectly to paint the picture. It was like a mythos of the brilliant autistic wonderkin who sleeps on a beanbag.
Yep.
And who doesn't give a shit about crypto, but just wants to make a lot of money because of charity.
Because of effective altruism.
Yeah. Which is like, it should have honestly been one of the bigger red flags. He's straight up
a bitch.
What's up?
Hindsight's a bitch.
It really is, yeah. I mean, everyone loves to, in hindsight, to say like, see, it was obvious. But, I mean, at the end of the day, when it was still running, FTX was a great product. I mean, it was it was the exchange that everyone wanted to use.
I don't think you could say. Well, okay. So I've never used it, nor did I ever recommend it to a friend because I just didn't think it was a real product because it had crypto shitcoins on there. With that said, I mean, they were papering Bitcoin, meaning like you go buy a little bit of Bitcoin. It's like, yeah, cool, man. I'll hold the Bitcoin for you. And they would just, there was no Bitcoin on the other end, or they were getting the Bitcoin and then trading that Bitcoin and oops, lost it. So sorry about you. And that's the thing that I've come to realization is the fact that they papered so much Bitcoin, which is a big attack vector, which we should talk about another time. But going back to the orchestration of this, it was just insane to me that we talk about the failure of due diligence, but like it was everyone just pointing the finger at the next person down the line and just saying it was, oh, I thought this person covered him, supported him, so of course I was in.
Mm-hmm.
I don't know. I mean,
well, you'll see this in media, right? Like there are trends, and there are topics of the day, the week, and the month that you'll see like one outlet cover and then the next outlet covers it. And then it's just a domino effect. This is pretty popular in all types of reporting. You can see it too in Bitcoin and crypto journalism. When there's a topic that's hot, all it takes is one big outlet to cover it. And then all of the other smaller outlets or trade publications will then syndicate what they said through their own coverage or just kind of pick up on the trail and do their own stories of it. And Sam was the perfect guy for the mainstream media coverage of Bitcoin because he straight up told people he doesn't give a shit about crypto. And he told people that he wanted to give all of his money away. And he's like this like this vegan who talks about how proof of work is bad, how Bitcoin is not the future of payments, and who talked about donating money to pandemic preparedness to avoid the next pandemic, right? And so for all of the legacy publications, this just ticks all the right boxes, right? Like this is a guy that we can
They need
cover.
that Vince McMahon meme of every time going down.
Yeah, exactly. And this is just the perfect guy for them to look at and say like, okay, like if we're going to get behind any crypto story, we're going to cover him. And that's kind of a more charitable reading of the situation. Then we can get into like all of the money that he gave to like, he donated to Vox, he donated to The Intercept, a bunch of other publications. Depending on what part of the conspiracy that you subscribe to, if he really was, somehow intertwined with the elite or the deep state or whatever you want to call it, they were pulling all the right strings to make sure that he got the coverage that he needed.
And from your opinion, where does media go from here in terms of covering folks like a Sam?
I don't really know how to answer that question because on the one hand, like let's give credit where credit's due. Like this whole blow up started with CoinDesk's reporting on FTX and Alameda's ties, where they looked at the first report on this was by Ian Allison, great journalist at CoinDesk. And I want to go on the record saying that CoinDesk has some very good journalists. They have some very bad journalists, but they also have some very good journalists, and they have some good leadership and bad leadership. Ian's one of those good journalists, and he broke a story about how Alameda's balance sheet was like mostly FTT, or like I think it was like a third of it, and then the rest of it was like shitcoins.
Yep.
And so there's always going to be a place for certain media. It's just a matter of like, will the big organizations be able to provide coverage that is more beneficial than the kind of like guerrilla journalists that you see coming on Substack, right? And I think we're hitting a critical mass with the Substack journalists too, right? It's like everyone has a Substack now.
Yeah.
And like on the one hand, I'm happy to see this. Like I believe in citizen journalism, guerrilla journalism, like, journalists going on their own and doing their own thing. But like, if I'm thinking about like my pocketbook, like what's better for me, subscribing to one outlet with a bunch of really good journalists or subscribing to 20 journalists that are all independent? It's the former every day because it costs me less money. And, hopefully if the outlet is structured properly, I can get all of the 20 good journalists just under one house.
Yep.
Right. But all of that being said, this is another huge L for specifically like, I won't talk about any other like political journalism is its own thing. That's all kind of just like an entertainment. And business journalism, I can't really speak to the nuances of, but like crypto journalism and as a whole in the mainstream is just dog shit because all of these outlets are kind of confronted with this problem of we don't have anyone who is we don't have anyone who is like, a full-time crypto journalist or has like built their career on crypto journalism because this is all a new thing. So what do? They go to the closest millennial usually or Gen X who covers tech, who covers stocks, who covers business, etc., who covers finance, and they say, okay, this is your beat now. Like you have to cover this thing. And that person, if they're, if they don't care about Bitcoin or cryptocurrency, chances are the most interesting thing that they think about the industry is talking about how fraudulent it is or how much it's going to like destroy the world because it consumes too much energy or how Tether is going to blow everything up because it's just printed money. And so for all of the mainstream journalists, they seem to approach Bitcoin and cryptocurrency with this kind of nihilistic lens of this thing is only bad. And the only serious way to cover it is to show that it's bad. And these publications don't want to get someone who is an actual Bitcoin freak or a crypto head onto their masthead because then they see it as a conflict of interest. So like it's this weird catch-22 where it's like you're never going to get someone who actually understands how to cover this stuff unless you get someone who's interested in it.
Yep.
Because they're the only people who actually understand how it works. And this is why actually the crypto publications, by and large, even for as bad as they may be on certain things, they blow all the other publications out of the water.
Because they get it.
because
To
they
a
get
degree,
it. Yeah, because I've worked with a lot of people at CoinDesk, right? A lot of writers at CoinDesk who, like, even if they're not like obsessed with Bitcoin, they own some of it and they've played with it. And so they understand the problems, they understand the things that are actually worth talking about.
Yeah. So we are in the heart of a bear market right now, and things from the outside looking in, I would say, look bleak. But inside, I'm still as bullish as ever, even on the mining front, even on Bitcoin development, grassroots community development, and so on. I hope we do this more often, by the way. I got a couple ideas, and I'm going to let you in on a couple of them. But I think this is a good place to wrap. Do you want to close with where people can find you, Colin?
Yeah, absolutely. You can find me at As I Lay Hodling on Twitter and on Telegram. For those wondering, that is a reference to Faulkner's As I Lay Dying, not the band As I Lay Dying. That's what everyone always thinks it is. I don't actually listen to metal very much or emo. Yeah, you can find me there on Twitter. You can also find my work on hashrateindex.com/blog. I got a newsletter I send out every weekend. And if you want to read Forbes, you can find me at Forbes Crypto. I'm one of their senior contributors for digital assets. So
Awesome. Well, Colin, I'm already looking forward to a part 2. But thanks again for your time, buddy.
thanks, Rod. I had a really good time. Appreciate it, brother.
Hey, everyone. I hope you enjoyed my conversation with Colin as much as I did. The thorough analysis on Bitcoin mining that Colin produces is valuable information that helps inform the entire industry, both in general understanding and decision making. If you're enjoying the pod and want to automatically stay up to date, please like and subscribe in your favorite podcasting app. And make sure auto download is on. This would also mean the world to me. Lastly, come visit us in Nashville at Bitcoin Park. The Bitcoin community here in Nashville grows stronger by the day. We hinted at a number of events, pop-ups, workshops, and meetups, and even launched Nash BitDevs here at the park. So if you want to be the first to know, join our meetup page at bitcoinpark.co and check the show notes for this episode for a link to the Bitcoin Park Discord server so that you can stay connected with us. Until next time.